And Vince, what part of Florida are you in again?
I'm in Winter Park, right outside Orlando.
Right outside Orlando. All right. Excellent. But you all ready for the holidays? I'm furiously online shopping.
Not at all. Not even close.
Ryan,
Not either. Yeah, I have a birthday always, Rich, right before Christmas. So I got to get through that first. Not that
your
we're going to be celebrating, but
your own personal birthday,
yeah,
right
yeah,
before Christmas.
right before Christmas. I'm one of those Christmas babies that mom and dad would just swipe a present underneath the tree and hand it to me for my birthday and said, "Here you go." I said, "Okay."
See, mine
So
is January 12th, just enough distance from Christmas where you still get double presents.
yeah, I wasn't
Yep.
so lucky. Dang it.
Happy Tuesday, everyone, and welcome to a very special 12 Days of TMC edition of the last week in Mortgage Today. I'm Rich Swerbinsky with the Mortgage Collaborative and here for our weekly whirlwind through all the latest in the mortgage industry and what a year it's been. And we're in the third week of the 12 Days of TMC, our third annual year-end virtual extravaganza. Many awesome keynotes over the last 2 weeks and going into this week, sessions, spotlights of some of our great preferred partners. For example, after this show, at the bottom of the hour at 2:30 Eastern, Fannie Mae's chief economist, Doug Duncan. Many of us in the industry know Doug to be one of the really funny and honest economists, one of the economists you don't dread listening to. So we've got him coming up at the bottom of the hour, and I'm sure our team will heavily link that in the chat for people that want to attend that session. So, but let's get on with it. And a special edition of the 12 Days of TMC means we always pick out some special guests as co-hosts for these episodes, and no exception this week. Back in the co-host seat for at least the third or fourth or fifth time, the Chief Mortgage Officer of Green State Credit Union, Ryan Doehrmann. Ryan, great to see you, bud.
Rich, appreciate you having me. Thank you.
And I love the Buddy the Elf in the background. And
Yeah,
those of you that have
excited.
seen Ryan on the show before know he's a devout Iowa fan. Hawkeyes. That is not a Wisconsin helmet in the background. That's
No, absolutely. Absolutely not.
Didn't want any of our Milwaukee or Wisconsin members to get excited there, Ryan. So
No.
and
And they just beat us in basketball, so we're not talking about that, Rich. Okay.
And we hey, we got a Big Ten team number one in the rankings right now in hoops, Purdue, and two of the Final Four in football. So good year for the Big Ten. We'll see how the holidays treat them.
Amen.
And our special co-host this week, very good friend of mine for many years, and I guess a new part of the network, the SVP sales of Meridianlink, Vince Fury. Vince, great to see you, man.
Likewise, great to be here.
And Vince, for years, ran an LOS by the name of Open Close. We have a lot of members that are clients of Open Close. Meridianlink recently acquired Open Close. We love that because Meridianlink is a longtime great partner of TMC. We've known and liked Vince and the Open Close management team and product for a long time. So when we saw that news at TMC, Vince, we were fired up. And then when I saw you were getting the Meridianlink spot on this show, I was even more fired up. So congrats, and tell us a little bit about the acquisition.
Thank you. Yeah, really super exciting. It's kind of the culmination. We're 5 weeks into it now, but it was the culmination of, close to 10, 11 weeks of, really making sure the two companies fit together really well. And it really did. The cultures are very similar, some major tech chops and industry experience. And I just got back from 3 days in California collaborating with the Open Close and the Meridianlink combined teams, and just super excited of what we're going to be able to do over the next 12, 24, 36 months and beyond. So going to bring some really great technology to the mortgage space.
It's awesome. It's just a strange time on the tech landscape for mortgage right now. The two of the bigger LOS platforms are in the midst of merger acquisition, and you got lenders that are out there, at this point, the ones that are looking to kind of see it through to the other end, that are really invested in what their platform is going to look like into the future. So just a lot of lenders kind of assessing the chessboard would be, I guess, my assessment of the situation now. Vince, is that an accurate assessment?
Yeah, to some extent. I think, you have a situation over the last 2.5, 3 years that things were so crazy. And, if a lender wanted to make a move, they just didn't have the resources to do it. They were too busy throwing bodies at volume and trying to serve their customers. So I think, as much as everybody, is being challenged with the current production environment, when it kind of started, I think there was a collective deep breath of like, oh my gosh, now I have some time. And if I wanted to focus on a technology upgrade previously and didn't have the bandwidth to do it, now I do. And I think there's a lot of that out there right now.
Absolutely. So excited to talk about all of that and more. So let's go ahead and get into it. And Ryan, we were going back and forth on email, all of us this morning, because, this has been a rough year to host a weekly mortgage show. Let me just put it that way. Honestly, but we got some great news this morning. What I would say is the best inflation number we've had all year. CPI, the headline consumer price index, the measure essentially of the prices consumers pay for things in America, much tamer than expected. In the most recent month, rising only 0.1% from October to November, well below expectations. Within that, core prices, which strip out volatile food and energy stuff, also came in well below expectations. And after we got these numbers, we saw the stock market rally like crazy. We've seen a big rally in mortgage bonds here this morning. And not out of the woods yet. I think we all remember last August, we had one of these and then got a couple bad ones after it. But there seems to be more supportive data to this being a more permanent step in the right direction and not a blip in the radar, which all of us in this industry would be sweet music to our ears, because we've already got some affordability and inventory issues right now. The interest rate piece of things would help immensely because there's a lot of demand out there to buy homes in America right now.
Yeah, it's huge. It's funny that you say you haven't had much to talk about, or at least a lot of positive here recently. And so I was hoping and had a good feeling about what the numbers were going to come out today. So was excited to come on because positive news, right? I'm in team optimist camp for next year, and this only helps solidify that thinking. But yeah, you make a good point. Definitely not out of the woods. The news hit. It's 8:30 Eastern time, Central, where I'm located in the heart of the country. It was 7:30, so I'm sitting down at the breakfast table as my 3 kids are getting ready for school with my iPad up. I know, but just waiting to see what these numbers were. Right, listen to some podcasts this morning too on what was going on, and just basically got out of my chair and did a huge fist pump, right? Because this is what our industry needs. Okay, optimism going into 2023 because it's been tough, right? It's everybody that you've had on and you talk to people around the country. It's been a tough past 6 months, and hopefully now, with what's going on, you dive into the data and you read it and see what's up and what's not. We know shelter always is lagging as well. But positive news, especially heading into the holiday season. Energy, gas prices are down. I saw that, and then I try not to watch the news because the negativity, right? Trying to feed positivity in my head. But last night, at least our local gas prices were way down. So. Which is a big need for people, especially with travel coming up. So was excited to see this, then the 10-year, of course, dropping, and anxiously waiting to see what rates were going to come out, right? And we're already, I think, Rich, I've talked about this on some other times that we've been on. We have lower rates here in Iowa for, multiple reasons. So we've been in the high fives, for the past few weeks, and so this only further dropped them, which will help, right? It'll help. It's a slow time anyway right now. I just got back before I jumped on. I was at lunch with some realtor partners of ours, and we were talking about their business and what needs to happen. And right, everyone's pretty much in agreement. We know that, the 2 and 3% market, without some drastic change, we're not going to get back there, but we need to get back to the 5% range, right, to get people off the sidelines and feel comfortable. So super excited about the news today.
Good stuff. And Vince, the Fed set to start their 2-day policy meeting today with their latest policy announcement coming out tomorrow. Can't see any scenario where they don't raise the 50 basis points everybody's expecting. But and I don't think you'll get the Fed to admit this publicly. Certainly, I don't think as part of their statement tomorrow. But this morning's data maybe have them rethinking some of the 23 rate hike projections that are baked into the Fed funds future markets.
Certainly. I mean, obviously the Fed's been extremely aggressive, and when we saw, blips the other way, they were very quick to go on their media campaigns to say, don't get overly excited. Our policy is not shifted. We're going to continue to affect interest rates the way we have until inflation is under control. Obviously, the market's already priced in tomorrow the adjustment that we're going to see coming here in the next day or two. But I think this, especially with the trending of the CPI data that we're seeing in some of the core areas, I think that does give us a little bit of comfort that we're not going to see the aggressiveness of rate increases in the first quarter and the second quarter of next year like we experienced in 2022. And that's really good news for our market. You add to that the fact that some of the other commodity prices, especially lumber, that affects our industry, is down, I think, 70% over the last 52 weeks. So I think that's going to continue to have better, a positive effect on where new home starts moving and hopefully increasing again. So yeah, the data is definitely pointing in our favor for potentially, an adjusted increase for 2023 over projections that we're seeing today.
Should be interesting. And Ryan, when you look inside the numbers of this inflation report, you talk about some of the good signs in it. Vince mentioned commodity prices and some of the supply line issues that have been languishing that are starting to subside. Inside this report as well, we saw big drops month over month in two areas that were kind of like the hallmark of pandemic inflation: cars and furniture. We all remember the horror stories about trying to get a car or trying to get a couch in 2020 and what that did to the prices of both. I think now with cars, we've seen 5 straight months of price decreases, including a big one this month. Furniture, a similar type trend. So again, we had this blip in August where we thought we had one good inflation number, and the Fed was notably very cautious. And again, they're going to be cautious outwardly here as well. But it feels a little bit like we are like on the way back, on the way out of this pandemic fueled inflation frenzy, and that things are starting to get back to normal. Is that the way it feels in Middle America and in Iowa?
It does. Glad you brought that up. I was, at church on Sunday. It was, we had a little coffee donuts afterwards, and our local used car dealer person was there that I've known for years, and just was kind of, he knows I'm in the housing business, and as a credit union, obviously we're a huge, I know it's a mortgage show, but we're a huge auto lender as well, actually the biggest in the state. So seeing that come down is a big thing for us. And I was just kind of picking his brain on the supply as well for used cars. Still a little issue there, but first and foremost, the prices have to come down regardless of what the supply is. So that was good news to see. And we actually kind of talked about delinquency on car loans as well here, just as from our credit union as a whole. We're still watching that, not out of the woods on that for 2023, but something that's on our radar.
Vince, we've talked about what I'll call the falling knife syndrome. Basically, you got 300 basis points in spread right now, priced between the 10-year Treasury and 30-year fixed rates. Historically, that's been a 200 basis point spread. That is despite the fact that credit and delinquency risk is at its lowest levels ever in mortgage in terms of investor confidence on how mortgages are going to pay and perform. So in theory, that spread should be a little bit less because that credit and risk and prepay risk and a couple other things makes up the bulk of that spread of a treasury that lacks all that. But if indeed I am right, and if we can get a couple more good inflation numbers in a row, even without the Fed as a big buyer of mortgage bonds, we could be primed for a pretty nice rate rally. Again, if indeed I'm right and inflation is trending in the right way, because there's a lot of additional fear pressed into the markets right now. To Ryan's point, I don't think we're going to get to 2 or 3%, but if inflation is indeed trending in the right way, we could get into like the mid fours. I mean, you've been in the industry a long time. The sense I'm getting, Vince, is that would do dramatic things to volume in new apps.
Yeah, and I'm not sure. I'm not sure we're going to see that kind of rally in 2023. I think we can very likely get back into the mid to low fives again. I think the important thing is you are seeing some cautionary data on newer production and performance on newer production that people need to watch out for. But, when you're talking about inflation and in some categories we have negative and trending negative, it comes down to cash in the pocket. And when wages haven't kept up with inflation, people are outspending their compensation relative to their debt. Savings rates are going down. I mean, we emailed back and forth about some of the balance sheet issues that some of the depositories are experiencing, which I think we're going to talk about a little bit. But if we can get, if this trend can continue and we can start seeing commodity prices going down where people are bringing home more money and start to see wages tick back up a little bit, everybody's going to be in a much more comfortable position, which ultimately helps the housing market. Will we get the fours again, mid upper fours? I think that's a tough bet for the next 12 months, but certainly an 18-month outlook, I think it's possible.
This is the last week in Mortgage Today. I'm Rich Swerbinsky with the Mortgage Collaborative. This week joined by the Chief Mortgage Officer of Green State Credit Union, Ryan Doehrmann, and the SVP of Sales for Meridianlink, Vince Fury. Good segue, Vince. And Ryan, the next area I wanted to go in is just, we've talked a lot about depositories and had a lot of great depository members like you co-host shows like this throughout the course of the year. The interest rate climate, obviously, challenging this year. It's led to more ARM production, more desire for adjustable rate products and other things that are typically depository portfolio loans. And, just in talking to the depositories throughout the year, it was like, in the spring and things were still, oh man, we're doing that. It's, still decent activity. And, we're doing that. We were able to put some ARMs in the portfolio. And then it was like, all right, rates shot up and all people want is ARMs, and all the depositories are like, okay, hold on a second. Like, you can only put so many loans on the books. And Ryan, it's largely too a byproduct of the deposits you have on the books, and Green State doing great and big, huge credit union, but you got to look forward too. And if indeed we do go into a recession or a little dip, typically you get some deposit pullout in that type of scenario. It's probably the type of thing that Green State and others are looking at, no?
Oh, absolutely. It's really been our main focus. Yes, I do head up the mortgage area, but I sit in our senior team. And so there's more credit union level areas that I'm pulled into. And this has been a huge push for us. And so I can't remember if I mentioned it to you, or I did, when we had the debate there at the last conference, but my biggest push was, yes, we have all of the secondary market products, but hey, we have this unbelievable portfolio loan product that kills everybody. Well, what I didn't mention is, during that time, we had already done way too many loans and put way too many loans on our balance sheet, really, pretty much used our entire allotment for the year. But what we're trying to do is help those borrowers when rates skyrocket 300 basis points, from April to June. So that's a problem when you do that. It's not an endless warehouse line of credit where we're just doling out loans left and right. And so we pulled back, right? We had to take a time out, putting all those loans on our balance sheet. at lower rates. Now, thankfully, they're ARM loans, okay, but good qualified borrowers that we're happy to take the risk on. But that pulls from your deposit base, okay? So what do you have to do then when liquidity dries up? You got to go get money, and to do that, you have to offer rates that are going to induce people to move the money to you. And that's what all the depositories that are on here listening right now, everyone's fighting for money. Okay, who's going to pay the most, which in turn can kill your marginal cost of funds, which then affects our in-house mortgage rates. And so that's the battle that we're in right now. And last peer report that we pulled, we were in the 99th percentile for deposit growth, which is crazy, but we've had to pay for it, and we're now trying to deleverage our balance sheet. We're trying to let some of these loans run off our books, but we're also letting a lot of our borrowing. So we're a huge Federal Home Loan Bank borrower, right? Well, in years past, it's been a great plan because where the Fed fund rates are, it's been cheap money to borrow and lend out. Well, what do you think the Federal Home Loan Bank rates are right now? Not good. And so we're trying to let that, we're doing a decent job of it, let that run off the books. But it's definitely a balancing act and something that we're all trying to focus on. And we've kind of shifted our focus from being a portfolio lender to a secondary market lender, right? Not all the time. It's just the season that we're in right now, right? You got to be able to pivot and make decisions for the betterment of your entire company. And I know there's others that are battling that too, which is great, which is why I love the TMC partnership, because now I can pick up the phone through these conferences and through these webinars and meeting people, and I can pick up the phone and call a bank, right? Banks and credit unions don't have to hate each other, right? With our different groups that we have, I've got someone in another state that I can call, or I can pick up and talk to Idaho Central or Lake Michigan or whoever, and try to brainstorm what we can do about it.
That's awesome. And Vince, Open Close, and Meridianlink, both a lot of depository clients. What Ryan is saying, consistent with what you're hearing from your client base across America?
Yeah. I mean, absolutely. I mean, in a normal, environment, depositories can just, sell assets off the balance sheet when they need to create more balance sheet capacity, short of raising deposits. And there's, it's easy to raise hot deposits, but when you're talking core deposits, a totally different story. So what happens is, in the current market, based on what they balance sheeted over the last 2.5 years, they can't liquidate assets off their balance sheet. So they can't create that balance sheet capacity by liquidating loans because they're well under market. So, I've talked to some of our customers that are talking about doing participations, maybe putting together an asset pool of participations and finding some other community banks or credit unions that have balance sheet capacity that want to be part of that participation, just to clear up additional tier one capital space so they can continue to drive portfolio. And then there's other, we have a number of credit unions that their lending strategy has always been portfolio, almost exclusively portfolio. So now we're getting them introduced to secondary market aggregators so that they can, establish those relationships to be able to start participating in the secondary market where they may not have previously. It's a challenge right now for depositories because there's no fast way, especially in the economic climate we've been in, to raise deposits, other than how Ryan described of paying up interest rates, which depending on how much you pay up, they technically could be hot because you're not going to keep paying those rates long term. So yeah, it's definitely a challenge in the marketplace right now, no doubt about it.
No, real quick, Rich, Vince brings up a good point because we're actually in the process of going through a securitization approval with Stifel, which I think is going to be huge for us, and that'll be big with our indirect lending. As I mentioned, we're a huge auto lender, but seeing if we can do that in the mortgage area too. But we have, for the last 5 months, been working the participation market. But when the Fed is not done raising rates, there's no one out there that wants to buy our loans, even if it's at 6% right now. So 6.5%. is still not attractive to people when you're looking, 60 days down the road to sell these loans. So that's why it's important at some point for the Fed to come out and, their rhetoric has to change on easing of the rate so that loan participation market can open back up for us.
Without a doubt. And that's the kind of the dilemma, right? When you have rates that shoot up, and in this case, because of a once in a lifetime pandemic and events that followed it, if you're sitting there with 30-year fixed rate loans at 6.5 or 5/1 ARMs at 5.75, I mean, we've talked about it all year. Who's going to pay 102 for that, right? I mean, the chances that loan is paid off in a couple of years is extremely high. So no chance to get a premium for that. But I think it just lends itself more to if we could get into the 4.5, then you'd have an ARM market, right? That would be 5-year ARMs in the high 3s or low 4s. And I think the secondary market, especially with the credit and the delinquency profile of loan borrowers today, I think it could generate, some interest and rev up that part of the secondary market as well in the next year. So we'll see what happens. Ryan, one other thing I wanted to, you guys are doing this new initiative, Iowa. I love, you guys are doing so many cool, creative things to really try to pay it forward in the industry. Anytime I see or hear things like that, I want to use this show as a platform to let you talk about it. So tell us a little bit about this 10 over 10 initiative that you're working on in Iowa.
Yeah, I'll try to go quick. I know we're running short on time, and I think I mentioned this the last time I was on too, but we're way farther advanced than we were last time. But we have challenged every credit union, and we want to open up to banks too in the state of Iowa. So it's a 10 over 10. So 10 years, we want you to pledge 10% of your asset base to doing home loans for the underserved. Mainly, that we're trying to end the racial home ownership gap in the state of Iowa, which again I've mentioned on this show that is the 6th worst in the entire country. And you think about that for Iowa. So we're trying to get others involved. Copy what we've done. We've had a year's work of this. Working with Tony Thompson at NAMBA on our guidelines. We've got stuff in place and happy to help. If anyone kind of wants to jump on, we're going to start in Iowa. We want to be able to let this go nationally as well on what we're doing. And we're using special purpose credit programs as well to help with it. And really, it's not out there for, yes, we're going to get business out of it, but that's not what it's about. We want others to join the cause to help us. And so by all of these home loans that we do is help bridge the gap for people of color, especially in our state and that racial home ownership gap. So trying to hustle through it because I know we're kind of short on time, but it's 10% of your assets pledged towards home loans geared towards the underserved that have traditionally been, have not been taken care of through normal wealth building capacity and home loans.
That's awesome. Kudos to you guys. It's one of those things it's easy to talk about. Oh, hey, we should do this. We should do that. But when the rubber meets the road, kudos to you guys for taking the lead on such a critical issue facing our industry and our country for that matter. Vince, before we go to Doug Duncan, and that is linked in the chat, which starts in a couple minutes, sponsored by our friends at Cenlar. We just love your perspective. I kind of framed it at the beginning of the show. I just think there's a lot of lenders right now that, using the lower volume right now to really assess their future, what the future of their platform looks like as a company internally and for their customers. And yeah, you're a very well-respected guy, a lot of experience in this industry on the tech side. We welcome any perspective or thoughts or feedback you have for those lenders as we get set to flip the calendar.
Yeah, I mean, it's certainly a good time to really look at the marketplace and see what's out there. I mean, a lot of times you kind of get set in your ways on what you're on and you don't really know what else is out there. So it's always good to keep your finger on the pulse of, the different providers and what they're bringing to market. It takes, an hour or two, to sit on and get a look into somebody's system and see how it might improve the processes and automation you have in place today while you have time. Because, at the end of the day, this business is long any way you look at it. We've been through many, many cycles over the years in this industry, but the one thing that's consistent is pretty much everybody in this industry is long. I've been seeing the same people in this industry for the last 25 years at different places. It's almost like, same faces, different places kind of thing. So, invest, look hard, invest, and take the long approach on how you're attacking your business and your technology.
Great advice to take us into week 3 of the 12 days of TMC, and to wrap up this week's special edition of the Last Week in Mortgage Today. Ryan, Vince, thank you guys so much. Really, really enjoyed the conversation and making yourselves available for this today.
Appreciate it.
Rich.
Thanks for having us on.
And to our audience, we're here every Tuesday live at 2 p.m. Eastern, also on podcast on Spotify, Apple. Search TMC Connect. Doug Duncan is linked in the chat. We'll see you there, and then back on this show next Tuesday at 2. Have a great rest of the week, everyone.
Have a good holiday season.
Have a good holiday, guys.